Welcome to Geojit Spotlight. New Year is around the corner. If 2021 was an exceptional year for Indian stock markets, 2022 saw many ups and downs due to various factors. How 2023 will evolve? Let's get insights from Geojit Chief Investment Strategist, Dr. Vijayakumar. Welcome, sir.
Thank you, Abhilash.
Sir, 2022 is coming to an end. How will you summarize the market performance in 2022 and the important takeaways from that?
When we analyze the performance of the Indian market in 2022, three features stand out. The first is the outperformance of the Indian market. 2022 has not been very favorable for equity markets globally because inflation became a major problem and the leading central banks of the world started raising interest rates. Our central bank RBI also raised interest rates. So rising interest rate is not a favorable environment for equity, and therefore globally equity markets corrected. All the major indices delivered negative returns ranging from 10% to 20%, whether it is Dow Jones or S&P 500 or Nasdaq or Japanese Nikkei or Chinese Shanghai Composite or the MSCI Developed Market Index or MSCI Emerging Market Index or Stocks 50 or the Eurozone. All markets delivered negative returns of 10 to 20%, ranging between 10 to 20%. But India outperformed with the positive returns of around 5.7%. So far, we are talking on 19th December. Till now, the return is 5.7%. So this is a very impressive outperformance. This is the first feature. The second remarkable feature of the market in 2022 is the phenomenon of Indian retail investors maturing and coming of age. We know that the total demat accounts, which were around 4 crores in March 2020, has now crossed 10 crores. So more and more retail investors are entering the market. More investors are investing through the mutual fund route. The total AUM of the mutual fund industry has crossed 40 lakh crores. The monthly SIPs, which is a very healthy development, has crossed 13,000 crores. So FII selling is not creating any impact. FIIs this year, till December 19th, sold equity worth around 1,45,000 crores. Last year also they sold around 54,000 crores. So these 2 years put together, foreign portfolio investors sold $30 billion worth of equity in the market. But this did not impact the market because domestic institutional investors were buying, domestic retail investors and HNIs were buying, and investors were buying mainly through the systematic investment plans and the mutual fund route. So this is a very positive development. I say this is positive because these are signs of Indian domestic investors maturing, coming of age, and the DIIs and retail investors maturing and coming of age is a major positive development because they are emerging as a countervailing force to the foreign institutional investors. FIIs are always hot money. They represent hot money. They are fickle investors. They will be guided by short-term considerations like movements in dollar index, etc. So this is the second most important development. The third development is, this is not a new development, but this development is happening very fast now. What I am referring to is the sectoral churns that is happening in the market. Sectoral churns are happening very fast. In 2020, the pharmaceutical industry was the best performing industry because of COVID and its impact. In 2021, the best performing industry by far was the IT industry, which delivered stellar set of numbers. In 2022, calendar year 2022, the best performing index is the financial services index. And within financial services, the public sector banks have surprised with very impressive returns. So these are interesting developments. And it is quite likely that next year also, at least in the initial quarters of next year, the banks will continue to do well because there is impressive credit growth in the economy. Asset quality of banks is improving. and that is likely to reflect in stock prices also. Capital goods segment is doing very well this year. They are likely to continue their good performance next year also. Commodities are likely to do well. So investors should also look at this sectoral churns that are happening in the market now.
What are the prospects for 2023? What are the challenges and opportunities?
In 2023, at least in the initial months, the scenario is not likely to be very favorable for equity, at least in the initial months, because the global economy is slowing down. There are three major pillars for the global economic growth. These three pillars are the US, the Eurozone, and China. But these three are now experiencing problem. Eurozone is almost sure to slip into recession in 2023. US might also go into recession at least for 2 quarters. And in China, the growth rate has slumped quite dramatically because of many internal problems there. So global growth will be low in 2023 and interest rates are rising. So rising interest rates and slowing global growth is not favorable initially for equities, because lower growth means lower corporate earnings. Lower corporate earnings means lower stock prices. I'm mainly talking about the global scenario. But even when the global economy slows down, India will be the fastest growing large economy in the world, but our growth also will be impacted, because when global growth slows down, global trade slows down. When global trade slows down, our exports will decline. When exports decline, it will impact our growth. So this financial year, FY23, India is likely to clock a GDP growth of around 6.8%. Next financial year, FY24, this growth rate is expected to come down to 6%. 6% is very good. It will be the best in the world. But then slowing economy and possibility of declining corporate earnings is not very favorable for equity markets. And a very important point that I would like to stress here is, market has already discounted the growth slowdown in 2023. Markets also have already discounted a mild recession in the US, mild recession. Market has not discounted a strong and deep recession, but a mild and slow, shallow recession. Therefore, when we have indicators, the market will be giving indicators. The dollar index will be giving indicators. The monetary policy of the leading banks will be giving indicators. The bond yields will be giving indicators. When these indicators start showing a positive move, then the market will start moving up. So initially, markets can be weak, but markets will go up going forward. But a very important point that has to be understood is, the market will continue to be weak because the uncertainty is very high. We know that from April 2020 to October 2021, there was a one-way rally in the market. In the global markets, in Indian market also, there was a one-way rally, which took Nifty from 7,511 in March 2020 to 18,604. That kind of a one-way rally without fluctuations will not be there for sure in 2023. 2022 we had big volatility. This volatility is likely to continue in 2023 also. 2%, 3% up moves and down moves, that will happen. But then from the investor's perspective, such volatility can be opportunities to make very good investment. That is the most important thing.
So what should be the investment strategy?
Well, this kind of volatility that we are having now, and which is expected to continue in 2023 also, can be used by investors as opportunities to buy high quality stocks and to continue their investments. Investors should not be focusing on 2023 and returns in 2023 or in 2024 and returns in 2024. Their focus should be on the long-term wealth creation that is almost sure to happen in the Indian stock markets. So the focus should be on 2028, 2030, 2032. By 2032, there is a consensus that India will become an $8 trillion economy with a market cap of $10 trillion. So the focus of investors should be to participate in this wealth creation that is likely to happen in the next 10 years. But for the very short term in 2023, investors should focus on diversification. In 2023, diversification is going to be more important because there are other asset classes also which are likely to do well. As I have earlier referred to, this is the scenario, an environment in which interest rates are rising. And when interest rates are rising, fixed income investment is good. So bank deposits are giving decent returns. More important than bank deposits, investors should also look at fixed income investments in the bond market. There are mutual funds which invest only in bonds, debt funds. And the advantage of debt funds is that they can give decent returns, better returns than the returns given by the bank deposits. And they have a very important tax advantage. In bank deposits, if you are in the 20% tax bracket, you have to pay 20% tax on the interest that you get on your bank deposits. If you are in the 30% tax bracket, you have to give 30% tax on the interest that you get on your bank deposits. But if you invest in a debt fund, the returns will be inflation indexed, and only the inflation indexed returns will be taxed. That means only the returns post inflation indexation will be taxed. So this is a major tax advantage. So investors should consider investing in fixed income, including investments in debt funds. That is another very important point. Also in 2023, gold is likely to do well, need not do well in the early months, but sometime during the year, gold will appreciate because gold price movements will be largely dictated by the movement in the dollar index. The dollar index has been rising because the US has been raising interest rates. Now the general consensus in the market is that the dollar index has peaked. It went up to 114. Now the dollar index is around 105. And if inflation comes under control and the Fed stops raising interest rates, starts pausing and then cutting, the dollar index will decline further and gold prices will go up. So gold also can be considered for investment in 2023. So the focus of investment, the main ingredient of an investment strategy should be this multi-asset allocation, diversification and multi-asset allocation, investments in equity, investments in bonds or debt funds, fixed income assets, and investments in gold. That can give decent returns in 2023.
Thank you, sir. Thank you very much.
Thank you.